Mark, it's great to have you. And there's, of course, some great anecdotal evidence to be had in Fed Minutes as well as the Fed's Beige Book. And I'm wondering, because it's been a while since we've had a chance to talk with you, how you describe this moment in our economy and how the president should state next week the state of our union is what?
Well, unfortunately, I'm not president, Joe. That's a tough one. Good luck with that. My sense of the economy is what depends on which part of the elephant you touch. I mean, you look at GDP, that's the value of all the things that we produce. It looks okay. We're going to get a read on that for the fourth quarter on Friday. It'll probably come in around 2.5%, which is kind of right down the strike zone. That's close to the economy's potential. But if you look at jobs, we're not creating very many. Feels like that's even before artificial intelligence kicks into any kind of gear here in terms of productivity gains. So as we see more of that going forward, I heard you talking about that just now. It's coming. We might see some job loss. I think it depends on where you're looking. But you add it all up, you mix it all together. It's okay. We're hanging in there. It just feels fragile to me.
Well, on the AI question, this is actually something that Bloomberg technology host Ed Ludlow posed to the San Francisco Fed President Mary Daly yesterday. Mark, this is what she told him, and then we'll have you respond.
What we're looking for is a technology to give us consistently good changes in productivity so that all industries at scale get better. Industries figure out new ways to generate revenue, new ways to do product design, new ideas to come and shape the economy. That's the thing that has a sustained productivity growth part. So it's undeniable productivity growth has gone up. What's not as clear is how long will that last?
So she speaks to the lack of clarity, the uncertainty around this question. Mark, how long is it going to take to feel the real effects are we talking about with the pace of the development of artificial intelligence and LLM models, that this could be within the span of months, potentially? Are we talking years? Is Kevin Warsh immediately going to have to answer this question when he gets to the Fed if he's confirmed?
Well, it feels like it's AI and its impacts on productivity growth are early stages. You can kind of sort of feel it in the economy over the past year. You can see it in hiring rates. They're weak. You can clearly see it in the tech sector. Tech jobs are falling, and their tech is on the front line of the impacts of AI. There's been some research that kind of sort of connects the dots. So it feels like it's starting to kick in, but just listening to the technologists and seeing the improvements in the power of these LLM models and the use of agents, it feels like we're going to get a much more significant increase in productivity growth here now going forward. It feels like underlying productivity growth right now, that's non-farm business productivity growth, is probably about 2%, which is close to the long run average. But if you told me, we had this conversation a year from now, it's 2.25%, 2.5%, I say that sounds about right to me. So I think we're on the leading edges of that. And Kayleigh, this goes back to the point I was making earlier. We're not creating any jobs now at 2% productivity growth. What happens if we get to 2.25%, 2.5% over the next year? Will we see enough demand for other things to create enough jobs to keep unemployment down, or are we going to start to see some job loss here?
Maybe AI can help to loosen up the or the housing market at some point, Mark Zandi, because there are big questions about where we're going with housing. The president is worried that lowering housing prices will ruin people's nest eggs, and Congress is busy trying to increase not only affordability, but inventory. It's something that we talked to Congressman Mike Flood about. The Republican from Nebraska helped to author a housing bill that just recently passed. In fact, he remarks on how popular this was on Capitol Hill. Listen.
390 votes, 9 no votes. I mean, that is something to celebrate. Unfortunately, it doesn't make the news anywhere on an issue that matters, housing. The good news is in the Senate, they have a near unanimous bill that they've moved to the floor and tried to pass before. And you've got the president who has ideas about housing. So here we have House Republicans and Democrats, Senate House Republicans and Democrats, and the president all saying housing is a priority. If we can't find a deal among those three entities, there's not a deal to be had.
Are you encouraged by this effort, Mark Zandi, and his cutting red tape, which essentially what this legislation is aimed at, actually help to loosen up the housing market?
Yeah, it's encouraging, Joe. I mean, certainly the bipartisan nature of the legislation, and you had Democrats and Republicans coming together and signing a piece of legislation. A lot of moving parts there. A lot of it is certainly moving in the right direction. None of it's a game changer. That's not a criticism because there is no game changers here in terms of the housing market. It took us, since the financial crisis to kind of get into this mess with regard to the severe shortage of affordable housing. It's going to take us a while to get out. So, this is a difficult problem, but it's a good piece of legislation. I mean, just give you a sense of it. In my mind, looking at the plethora of different parts of the legislation, the one thing that stood out was the elimination of the permanent chassis for manufactured housing. Now, that sounds really in the weeds, but that could be really important for manufactured housing. That's about 100,000 units every year. That goes to low middle income households, really helps with affordability, particularly in the South and the West, where that's a larger part of the housing stock. So, that's the kind of thing that was in the bill. Again, not a game changer, but certainly the direction of travel here, very, very positive.
Well, and on the subject of direction of travel and timing specifically, this bill obviously is meant to focus on the supply side, actually creating more housing, whereas the kind of rate mechanism from the Federal Reserve is more focused on demand. What happens if addressing the supply side, which to your point seems like it has a longer time horizon, you actually have to get these things built and available to buy, happens at a lag compared with rates potentially going down and unlocking more demand with cheaper mortgages? Could it actually create a much larger problem before it creates the solution?
Yeah, great point. This legislation that was passed, it feels really good because it's on the supply side of the housing market to, build more units to alleviate the shortage that we're suffering through. A lot of the other proposals that have come forward, a lot of them from the administration, are on demand side measures. So, for example, a 50-year mortgage or a portable assumable mortgage, or have Fannie Mae and Freddie Mac go out and buy mortgage-backed securities to lower mortgage rates.
Right.
That juices up the demand side. And, obviously that doesn't help when you're trying to improve affordability and keep prices and rents down. So this piece of legislation, great. The other stuff, not so much. But fortunately, I think the other stuff, not so much, is not going anywhere. I just don't think that has any kind of leg. So I think we will get some relief here as we move forward.
Do you share the president's worries that loosening up the housing market brings prices down and actually invades people's nest eggs?
Well, we don't want house prices to decline. That's not a great idea, right? I mean, 2/3 of Americans own their own home. It's for many middle income Americans, that is the largest asset that they have. They don't own stocks. They're not really benefiting from the surge, the surge in AI stocks. That's really just the well-to-do, the folks in the top part of the income and wealth distribution. So middle America, they're focused on their home. We don't want prices to decline. We want prices to kind of go flat here for a while, let incomes kind of catch up and affordability to improve. That seems to be what's happening. It feels like, house prices really haven't moved much at all since the Fed jacked up interest rates back in 2022. So now, 2, 3, 4 years ago. So that's the kind of thing we want to see. I don't think we're going to see price declines here, just because there's just not a lot of inventory. I mean, mortgage rates, while they have come down, they're still pretty elevated compared to the rates that most people have on their mortgage. So it doesn't make a lot of sense for people to list their home and move. There's not a lot of inventory, a lot of supply there. So I'm not too worried about prices declining, but we certainly don't want to see that happen.
Mark, we have less than a minute left, and I know a lot of people just write off the minutes as being too backward looking, but is there something you'll be looking for when those publish 6 minutes from now?
Well, what the message is going to be clear that we're not, the preponderance of the members didn't want to cut interest rates. The job market feels like it's stabilizing. Inflation's still too high and sticky. I think the thing that I would like to get out of the minutes, I'm not sure we will, but would like to see is just how strong that sentiment is, how broad-based that is across the committee, because that will say something about what's going to happen here in the next FOMC meeting down the road.